If you've been accumulating Bitcoin for a while, you probably have a massive capital gain on that Bitcoin. A lot of people wonder if they should continue buying more Bitcoin or if they should diversify into another asset. In this video, I want to explain to you why I think you should stick to Bitcoin and why diversifying into, let's say, stocks, real estate, bonds, or other cryptocurrencies is not the smartest decision. I got this question from one of my subscribers asking if it would be safe to just have one Bitcoin or less, depending on one's budget. I mean, of course, it depends where you are. Not everyone can afford one Bitcoin. Really depends on where you are. Some people will be okay with 0.01. Some people will be okay with 0.1. Some people will be okay with 10 Bitcoin. Some people will be okay with 100 Bitcoin. This question is basically asking, why wouldn't you want other assets while holding Bitcoin? So you can hold your Bitcoin, and at the same time, you can buy real estate, stocks, precious metals, all of that stuff. But the way that I see it, the only reason why all these assets are valuable is because the US dollar doesn't work as money. The US dollar can be created at will, so the base amount of money is always increasing, meaning that all of these assets aren't actually going up in price. They're not price, but value. What's happening is these assets are going up in price because the US dollar is losing value constantly. So let's say a house. A house should probably not go up in value. The only reason why it goes up in value and it goes up in price is because the US dollar can be created at will. Another reason why real estate goes up in price all the time, it seems like it's always just going up, is because real estate investors get tax benefits. And these tax benefits are only possible because the US dollar can be created at will. If the US dollar could no longer be created at will, what it would do is it would stop people from being able to get tax benefits. What the US government is doing is when they give people tax benefits to own real estate, they are allowing these people to have a subsidized ownership of that house. So whatever house they want to buy, the US government is basically giving them a subsidy to own it, to continue owning it. And they're doing this at the expense of taxpayers, and they're doing this at the expense of anybody who saves in dollars. What they're going to do is, instead of cutting their expenses, normally if they were to give somebody a subsidy, if they were to give somebody a tax benefit, they should be cutting their expenses to make up for that loss in tax revenue. But what they're doing in this case is they're borrowing more and more money. They're using this money to pay for their bills. They're using this money to pay for the military. They're using this money to pay for Social Security, Medicare, all of that stuff. And again, the only reason why they're able to do this is because the money that we use today can be printed out of thin air. If the world ever does end up moving away from US dollars, goes into using Bitcoin as the world reserve asset, the US government can no longer subsidize the ownership of real estate. And these tax benefits can go away pretty much within a few years. So let's say within the next few years, the entire world figures out that the US dollar is a scam and they stop using the US dollar. Their resources, their time, their energy, their whatever they have, all of the food, precious metals, they stop exchanging all of this stuff for US dollars. The US dollar will suddenly lose all of its value. We'll see hyperinflation. And in this case, the US government can no longer provide tax benefits to real estate investors. What happens to real estate in this case? I think the world will be a completely different place on a Bitcoin standard. I personally think that maybe you shouldn't diversify into other assets. And it's important to consider multiple things here when you're really thinking about this. So I personally think that if you hold these assets, your portfolio will trend to zero forever. If you hold a certain amount of Bitcoin, let's say you hold one Bitcoin and you have $10 million in other assets, your portfolio will trend in value to one Bitcoin, no matter what. Over the long term, it will always trend to one Bitcoin. I've done the calculations for this. I'll show you the calculations a little bit later. But to me, it doesn't truly make sense to buy these assets because Bitcoin is a better savings tool than all of them. Bitcoin is a better savings tool than US dollars because US dollars can be created at will. Bitcoin cannot be created at will. Bitcoin has a maximum supply. This is like saying that instead of holding dollars, you hold a portfolio of a bunch of different currencies. You add in some of the Zimbabwe dollar, you add in some of the Venezuelan peso, whatever the currency is, all of the worst currencies there are, Nigerian naira, all the currencies that are constantly losing value, what you're doing when you're diversifying is you're holding some dollars and you're holding the rest in your portfolio as well. You know for a fact that all of those currencies are going to lose value, but you're still holding them because you want diversification. Diversification only works when people want passive income, when they want an income source that they don't need to worry about. And clearly that's not going to work over the long term. I personally think that the assumption that most people are making is that US dollars will be valuable in the future, meaning that people will have to buy real estate and stocks and bonds and all this stuff to save. But I don't think that's going to be the case. I think what's going to happen is demand for all of these other assets is going to drop off a cliff. It's going to decrease significantly. At the same time, the people who own these assets are going to want to sell because Bitcoin is a much better asset. In general, Bitcoin is a much better asset. And you can see that over the last 10, 12 years, even since 15 years ago when it was first created. But I mean, just to smooth it out a little bit, we can go 10 years. Bitcoin has been a better performing asset compared to literally everything in the world over the last 10 years, other than certain stocks, let's say like MicroStrategy and NVIDIA. NVIDIA has outperformed pretty well, but you wouldn't want to hold all of your wealth in those assets because both of them are centralized. So if you had 100% of your wealth in MicroStrategy and something happened where, let's say the US government wants to confiscate their Bitcoin, or they hold their Bitcoin with Coinbase, and Coinbase's Bitcoin gets confiscated, you're screwed. You're done. You can't get that Bitcoin back. It's a centralized entity. Same thing with NVIDIA. People always compare Bitcoin's performance to NVIDIA's performance, but Bitcoin is decentralized. NVIDIA is centralized. NVIDIA's operations could easily go to zero. People could find another company. There could be another disruptor at some point in the future. There could be a technology that comes out that replaces what NVIDIA is creating. NVIDIA didn't discover anything. They're just producing a product, and it seems to be that they have the best moat. They have the best advantages of people see the advantage of using the products that they have. They're very high quality, but eventually this can be disrupted. There's no way we're going to stay on the same technology that NVIDIA is creating forever. That's not going to happen. On the other hand, Bitcoin is decentralized. Bitcoin is the discovery of digital scarcity. So what I mean by that is that it's the first time we found something that's scarce and digital at the same time. Every other way of creating digital scarcity requires central parties. With Bitcoin, it doesn't, right? So when you have US dollars, for example, US dollars are just digital entries. They're ones and zeros. That's it. But the thing is that they're centrally controlled. So there's a group in the middle that can control the supply and demand for US dollars. So the Federal Open Market Committee, essentially, they set interest rates, meaning that they increase demand by lowering interest rates, and they decrease demand for US dollars by increasing interest rates. So when somebody wants to borrow money, for example, when somebody wants to borrow money to buy an asset, for example, they are going to pay a certain interest rate, and the Federal Reserve is going to set this interest rate. If the interest rate is higher, there's a lower likelihood that they're going to want to borrow money to buy that asset. On the other hand, when you have lower interest rates, people are more willing to borrow money to buy those assets. So the prices of all of these assets are purely actually not precious metals as much, because precious metals actually have utility. They're something that they're scarce. They're harder to produce. But with Bitcoin, it's a little bit different. With real estate, this asset is already distributed. A lot of the people who want to buy real estate, they already own real estate. So over time, we're going to see that these interest rates are having a bigger and bigger impact on real estate's value. On the other hand, when Bitcoin hit its last all-time high, interest rates were at zero. Bitcoin was at $69,000. Interest rates were at zero. When the Federal Reserve started increasing interest rates, Bitcoin dropped to about 16,000. We can see from this chart here what happened with Bitcoin over the last little while. So right here is where we had the previous all-time high. This is where interest rates were around zero. So people were borrowing money for free. They were buying Bitcoin, and they were pretty much just gambling at this point, right? They were just buying at the highest price of all time. At this point, the interest rates were zero. So the Federal Reserve had total control over how much money was in the market. They had increased the amount of money that was in the market, and they left it at that point. So Bitcoin's price increased, more money flowed into Bitcoin because more people understand what Bitcoin is over time, and they want to buy it. They want to put their money into it. When the Federal Reserve increased interest rates, of course, Bitcoin dropped. It dropped to about $15,500. FTX collapsed, BlockFi collapsed, Celsius collapsed. All these institutions collapsed because they were over leveraged. They had borrowed way too much money. They had US dollar liabilities, and they had Bitcoin in their reserves. So essentially what they did was they had borrowed way too many US dollars, and they had gotten greedy, and they used these US dollars to buy Bitcoin or to buy whatever other cryptocurrencies they wanted to buy, whatever they wanted to put their exposure in. So they bought all these assets. The US dollars interest rate, the interest rate on their debt started going up, and this is what happened. All of those people who had over leveraged themselves collapsed. They all failed, every single one. Today, we have a very different scenario. A lot of people say, "Oh, we haven't gone past the all-time high in 3 years. There's this, there's that." There's always all these excuses for why Bitcoin is trash. When you look at the real picture of what's happening, you realize that Bitcoin is not trash. It's completely outperforming where it was back here. So when we look at the market right now, interest rates are at the highest they've been in a very, very, very long time. Right now, all of these other assets are starting to collapse because it takes time for, let's say, real estate to collapse. Real estate takes really a long time because people will do anything they can. They'll borrow more money to pay their bills, to pay their mortgage. But the thing is that eventually they lose that ability. They can't borrow more money anymore. They can't pay their bills by borrowing more money. They can't use their credit card to pay their real estate, their mortgage. So what happens is with real estate, it takes time for the market to react. So with Bitcoin, it took 1 year from this top all the way to this bottom. With real estate, it could take 3 years, 5 years, 6 years. In the previous crash during the Great Financial Crash, whatever it was, from 2007 to 2009, real estate prices bottomed in 2011. The crash started in, I believe it was 2007 or 2008, and they bottomed in 2011. At that point, the Federal Reserve, before that, Federal Reserve started decreasing interest rates. I can show you what the interest rates look like here. So we can see here that the Federal Reserve started decreasing interest rates in 2008. The housing market didn't see its bottom until 2011. So it took a long time for the housing market to actually hit a bottom, for the interest rate increases that happened here. All of these interest rate increases went from 1.25% to 5.25%. This time we went from 0 to 5.25%. So the difference in interest rates, the difference in the scenario, more and more people have taken on leverage, more and more people have borrowed a ton of money. So what's happening now is the real estate market is seeing this contagion, and we're seeing prices drop. In Toronto, real estate prices have dropped by something like 30%, which is massive. But I mean, of course, they still haven't dropped enough because there are still a lot of people who are just listing their properties at a massively high price, and they're okay with waiting. They don't care if people can't afford their property. They think they deserve a certain amount. They think the market is eventually going to recover. But eventually, what's going to happen is, because of these interest rate increases right here, those people are going to feel the pain. There's going to be more and more foreclosures, more and more people defaulting on their loans. And the people who are stubborn, they have their price set at a certain level, they're going to be forced to sell in the future when they can no longer pay their bills, when they lose their job. More people are going to lose their jobs because of this. This is intentional. These interest rate increases are intentional. The goal here is to make sure that inflation doesn't go too high. This is all centrally planned. The only reason why the US dollar even has value is because of these centrally planned ways of, I guess, taming inflation, as you can see here. There's a group in the middle that's doing this. They're deciding what the interest rates should be. There's a group of 12 people who decide this. But the world is figuring it out. the world is figuring out that it doesn't really make any sense to continue holding dollars. And these interest rate increases, of course, they made a difference. They made a lot of people go bankrupt. They made a lot of people let go of the assets that they have, but they haven't made a big enough impact yet. Inflation is still, it seems like prices are still going up here and there, like for food, for example. There are certain things that are decreasing in price. Like I said, real estate prices have dropped by about 30%. But it seems like we're in a period of stagflation where prices keep going up, but productivity doesn't increase. And that's a result of inflation. That's a result of interest rates being at zero for way too long. From March 2020 all the way until March 2022, rates were at 0%. 0%. So people were able to borrow essentially for free. They were able to buy whatever they wanted to. They were able to over leverage, and they saw their asset prices going up, and they bought as much as they could. They gambled. They pretty much went all in on these things like houses, like rental properties. And eventually what's going to happen is the tenants that they have are going to be the ones that force them to default. So let's say somebody has 30 or 40 properties. They hold all these properties and they're relying on their tenants to pay the interest on the to pay the mortgage on this property. What's happening with these interest rates is the companies who employ those tenants can no longer keep them employed. They have to lay them off. They have to get rid of them. They're going to either replace them with AI, they're going to replace them with robots, because these interest rates make it so that they can't borrow money anymore and they can't fund this person's salary. So it's a domino effect. When these interest rates go up, companies start reining back on their spending. They start cutting back on their spending. They start laying people off. They start getting rid of employees. They once these employees lose their jobs, they end up having to default on their mortgages. Let's say we have another 3 or 4 months where the landlord is saying, okay, I'll give you some time. You can pay me the mortgage in 2 months, but you still owe it. You can pay back rent over time. And eventually, there are going to be people who can't find another job, who can't find another source of income. And now they can't pay their mortgage. And what happens to these properties? The landlords have to sell their properties because otherwise they're going to go bankrupt. They're not going to be able to pay the mortgage on their house because they need to use their income to pay the mortgage on this rental property. This is just how things work out. This is the way that the current financial system is designed to be. So what's going to happen is in the coming months, I think in September of 2024, the Federal Reserve is going to decrease interest rates. They're going to make it easier for people to borrow dollars. They're going to make it so that, let's say these interest rates go back down to 0% at some point. They're going to have to. Otherwise, there's going to be so much contagion. So many people are going to have to default on their homes. We're going to see deflation eventually. And that's one of the Federal Reserve's mandates: avoid deflation at all costs. They want inflation to be at 2%. So back to the question here. Why would you want to own something that's purely centrally planned, purely controlled by a small group of people? That's what real estate and stocks are. Real estate and stocks rely on interest rates being low so that the people buying them can continue to make profits. The companies who back these stocks can continue to pay their dividends. Eventually, they won't be able to. So what happens here is if the US dollar fails, what you're doing is you're buying these assets that rely on the US dollar continuing to be pumped into the economy. And if it's pumped into the economy, these assets will perform well. If it's not pumped into the economy, these assets will underperform. And again, we can go back to this chart. We can see here that interest rates right now are at the highest point they've ever been. Interest rate here, we're at the lowest point they've ever been. So what happens to Bitcoin when interest rates start dropping again? What happens to Bitcoin when the Federal Reserve finally realizes that they've tightened too much, they've increased interest rates too much? Now people can't afford to pay back their debts, and now there's going to be some problems with banking. Banks are going to start collapsing. That's what happens when interest rates stay too high in a over-leveraged economy. So what Bitcoin is doing here, go back to Bitcoin here. When interest rates go down, when interest rates finally start going down, because there's some uncertainty right now, people are still thinking that the Federal Reserve may not lower interest rates. But when interest rates finally do go down, maybe that won't be in September, maybe that won't be in October, whenever the next meetings are, maybe it'll be in December, maybe it'll be in 2025. What's going to happen to Bitcoin's price? It becomes easier to buy Bitcoin. It becomes easier. I talked about Michael Saylor's strategy in my video from yesterday, where he's borrowing as much money as he can to buy Bitcoin. More and more companies, more and more individuals are going to figure this out. More and more people are going to start doing this. And that's what's going to make Bitcoin's price go all the way up to 125, 130, 150, because almost nobody has an allocation to Bitcoin. Almost 99% of people don't have an allocation to Bitcoin. They have no allocation whatsoever. And all these people are eventually going to want it, because now that Wall Street has stepped in, we have the ETFs, the exchange traded funds, which are making it a lot easier for people to access Bitcoin. When interest rates drop, those ETFs are going to outperform significantly. And all the people who own these other assets, people who own stocks, real estate, they're getting their 3 to 5% returns. And maybe it won't be enough anymore, because inflation will start shooting up. Eventually, these real estate properties won't outperform inflation. And that's the problem here. So if you were to diversify, let's say you were to buy all these other assets, let's say you buy 1 Bitcoin and then you have 99% of your portfolio in other assets. Or if you buy 1 Bitcoin and then you start accumulating other assets. All you're doing is you're giving your money to a system that's going to collapse eventually. It's designed to collapse. It's not designed to last forever. This financial system, the financial system that real estate and stocks are a part of, is not designed to survive forever. Precious metals are a little bit different, because real estate and stocks essentially require institutions and financial institutions to fund their purchases. Nobody's going to be able to buy a $900,000, $500,000, $300,000 real estate property if banks didn't exist. If banks start shutting down, if we see a credit crunch, we're going to see real estate properties drop significantly. We're going to see stocks drop significantly, because the people who own these things, most people already own these things. Most people already own a house. Most people already own stocks. 50% of Americans already own stocks, something like 50%. But there are 150 million houses in the US. So the people who are living in the US already own these things. If they need it, they already own it. In reality, people own too much of these things. People own way too many rental properties. People own rental properties because they know that the US dollar is going to collapse. So let's go to precious metals here. Precious metals are great because with precious metals, you're basically hedging against the possibility of the internet stopping working, not working anymore. The electric grids going down, all that stuff. Basically, you're betting against the modern economy. But if the modern economy just keeps going, if it keeps going the way that it is right now, precious metals are going to be worthless. I mean, I'll show you the charts, but when you look at the charts for real estate versus Bitcoin, when you look at the charts for stocks versus Bitcoin, precious metals versus Bitcoin, they're all going to zero, because on a Bitcoin standard, none of these assets are worth anything. So I get what this person is saying here. I get what JR is saying here. If Bitcoin truly goes to the moon, 1 Bitcoin will be more than enough to live a good life. Of course, 100%. But why would you want to intentionally diversify into something that is almost guaranteed to go to zero? Keep in mind that there are some things that you need to know here. JR is 60 years old. If it was me personally, I would not buy any of these other assets. I'm 31. I know a lot of people who are watching this channel are between 25 and 35, somewhere between 35 and 45. So for you, maybe it would be smart not to diversify. Keep in mind, diversification is all personal. It's all about what you can handle. If you can handle these massive changes in price, if you can see your portfolio drop from here all the way down to here, and you're not going to panic, then of course it makes a lot more sense to hold Bitcoin. I personally started buying Bitcoin somewhere around here. I think it was. I started buying when Bitcoin dropped below $40,000. But at that point, keep in mind that I didn't completely understand what I was buying. I was still buying stocks. I still had plans to eventually at some point buy a rental property. I was still buying the S&P 500, but somewhere around, I think it was somewhere around here, I really figured out what Bitcoin was. I think I fully was orange pilled at this point. I fully realized that the old financial system is literally designed to steal wealth from anyone that doesn't understand how it works. So if you don't understand how the old financial system works, you're going to be stolen from. That's where I realized that Bitcoin is the thing that I want to hold on to forever. And I don't want to hold on to anything else. I got rid of all my index funds. I got rid of all my stocks. The only stocks that I hold now are MicroStrategy, and I hold Bitcoin. That's the only things that I hold. And again, the reason why is because I finally realized that the entire financial system is designed to steal from us. So why would I want to continue to fund it? Why would I want to continue to invest in it? Now I'm going to switch over to a spreadsheet, which is going to show you that if you allocate a certain percentage of your portfolio to Bitcoin versus stocks, how your portfolio will perform and what kind of difference it'll make. So at this point, I think you can make the decision yourself. So if you want to diversify into stocks and you want to diversify into Bitcoin, go for it. But maybe it's not the best decision. So let's switch over. If you need to, lower your brightness now because I'm going to switch over to an Excel spreadsheet. This spreadsheet, I'll zoom in later. I'll show you the numbers. Basically, this spreadsheet shows you how much Bitcoin is being, how much of your portfolio is being allocated to Bitcoin versus how much is being allocated to stocks. And it shows you the final value of Bitcoin. It shows you the final stock value, shows you the final percentage allocation for Bitcoin, and it shows you the final allocation for stocks. It also shows you the final portfolio value. I'll zoom in a little bit more here. So final portfolio value here. So you can see here, I actually separated the ones that I think would be the most important. The assumptions that I was making for this portfolio, I should have actually mentioned that earlier, but the assumptions that I'm making for this portfolio is that you have a 20-year time horizon. So you're not selling for your rent. You're not selling this for your whatever payments you want to make in the future. You're holding on to Bitcoin for the long term. This is money that you're not going to touch. You're leaving it there for as long as you can. 20-year time horizon, 35% returns for the first 10 years, and then 30% for the following 10 years. I think this is conservative because keep in mind, 99% of people do not have any allocation to Bitcoin. I think over the next few years, because of the Bitcoin ETFs, we're going to see the flood of investors, flood of savers coming in to buy Bitcoin because Bitcoin is going to outperform everything. And as it outperforms everything, more people are going to come in and it'll make it outperform even more. So based on that, these are the numbers that I chose. You can adjust it if you want to. I don't really know what you would want to change them to. Maybe if you want to put it to 20%, 10%, however you do it, up to you. We also have 7% returns for stocks. So on stocks, we have we have been getting a 7% return pretty consistently. It's been happening. I don't see that as a bad estimate. Okay, so based on these assumptions here, 20-year time horizon, 35% returns for the first 10 years, 30% for the following 10 years, 7% returns on stocks. Keep in mind, again, we could see 100% returns for the next 10 years and then 5% returns for the following 10 years. I'm not going to model that, but based on these returns, let's see what this portfolio would look like after 20 years. So what you'll have is if you allocate 1% of your portfolio to Bitcoin from the beginning, you do that and you just leave it as is, you'll have $1,009. At the end of it, your 1% would have gone to 60.396% based on those returns. If you have a 2% allocation, your Bitcoin portfolio, your Bitcoin allocation would be 75%. So the more you allocate to Bitcoin, of course, the bigger the portion of your portfolio would be allocated to Bitcoin. So over time. So let's say you start with 1%, you'll have 60%. You start with 2%, you'll have 75%. If you start with 10%, you'll have 94% in Bitcoin. If you start with 20%, you'll have 97% in Bitcoin by the end of that 20-year period. If you start with 30%, you'll have 98% in Bitcoin. After this, the percentages, of course, don't really change that much because they get closer and closer to 100%, 100% at 100%. But what does change is column K here, the total portfolio value. So you go from having $1,000 in your portfolio, you start with $100, so you start with $1 into Bitcoin, $99 into stocks. You have $609 in Bitcoin at the end of it, $399 in stocks, 60% Bitcoin, 39% in stocks. $1,009 is your final portfolio value. If you go with Actually, let me just switch over here. It'll be easier. If you go with a 10% allocation to Bitcoin and you stick to that 10% no matter what, you don't sell your stocks, you don't sell your Bitcoin, you don't rebalance or anything like that, sticks to that return, you end up with $6,400. You went from $1,009 to $6,400. If you keep 30%, you end up with $18,000. If you keep 50%, you have $30,000. If you have 100%, you have $60,000. So because JR is 60, and because he has a shorter time horizon than myself, or than most of the people watching this channel, maybe it's up to JR to choose how much his allocation should be. If he has one Bitcoin, I think that one Bitcoin will do great. But it depends on what else he has in his portfolio. Let's say he has a $10 million portfolio. He has one Bitcoin, $60,000. You have a very, very small chunk of your Bitcoin of your portfolio in Bitcoin. But eventually that percentage, whatever that percentage is, let's say one Bitcoin is 1% of your portfolio, that portfolio will still increase in value. It'll still go from $100 today to $1,000 20 years from now. But if you're to allocate more, that portfolio will give you a lot more. So in this case, you have to find the right balance. If you're okay with your portfolio being volatile as hell, like just going up and down, just jumping up and down all the time, if you're okay with that, maybe it would be better for you to have a bigger allocation to Bitcoin. If you know that the old system is going to fall apart, then why would you want to put money into it unless you have a short time horizon? If you have a short time horizon, of course, it's different. If you have a short time horizon, you want stability, you want security. You may buy bonds because you get the consistent cash flow. You may buy a rental property to get that consistent cash flow as well. You may buy stocks to get dividends because you also may think that stocks are the future. You also think that stocks will continue to outperform for however long. Maybe you'll buy index funds. But the issue here is that you're giving up a significant portion of how much wealth you could maybe pass down to your children, your grandchildren, your great grandchildren. I think a lot of people who are figuring out Bitcoin right now are building legacies that they'll never be able to compete with. If you're buying Bitcoin right now, let's say, for example, you can buy 100, let's say your portfolio is worth 100 Bitcoin. You exchange the entire thing for Bitcoin. You have real estate today, you sell it all, you buy Bitcoin. At a point, your descendants will never, ever, ever, ever be able to accumulate the same amount of Bitcoin that you were able to, because your portfolio's value will continue to decrease in terms of Bitcoin forever. So if your portfolio decreases in value by 99%, you're able to give your descendants 99% less value. So it's up to you. If you're okay with putting your money in a system that will always extract value from any investors, any savers, then that's perfectly fine. If you want to have the stability that your government offers you, then maybe that's a trade-off that you're okay with. But if you want to stop losing your wealth to inflation, if you want to stop losing your wealth to taxes, if you want to stop losing your wealth to property taxes, or whatever else is happening in the system where these people at the top are extracting wealth from us, they're controlling our entire system, the FOMC, the Federal Open Market Committee, the Federal Reserve, they're basically controlling the entire system. If you want to get away from that, maybe allocating more to Bitcoin would be a better choice for you. I think the main point with diversification is that it protects you against the unknown. So for example, when you buy the S&P 500, it's pretty much expected that you very likely don't have a finance background. You're not running spreadsheets and looking at earnings reports and financial statements on a daily basis. What you're doing is you're buying the 500 top companies in the US, because if one of those companies fails, then you're still fine. It doesn't really impact you very negatively. You can still continue with your portfolio. Your portfolio is not going to go to zero. But what happens if the US economy collapses? In that case, you're kind of screwed, right? So this is something that you need to think about. This is something that most people don't think about. So if you're going to buy stocks, if you're going to buy real estate, if you're going to buy all of the other investments, you need to diversify even more. So the S&P 500 wouldn't be enough diversification, in my opinion. If I were to go back to buying stocks, I would have to buy international stocks, because if the US economy something happens to the US economy, the US economy falls apart, your stocks are going to fall apart as well. That's something that you need to consider. With Bitcoin, what you're doing is you're buying one asset that can be used anywhere in the world. Anyone in the world can demand it. The supply can be bought anywhere in the world. It can be used anywhere in the world. The asset is exactly the same no matter where you go. Because the asset is the same no matter where you go, what this means is that one country's collapse won't take down your entire portfolio. So if you were to only buy the S&P 500 today, you're not diversified enough. You're only diversified within the US. If the US has something happen, if the US has to increase its interest rates, if it has to increase its tax rates, those investments may do very poorly. I think diversification is great if you don't completely understand the risks of owning certain assets. So for example, some people don't completely understand what Bitcoin is. They don't understand that the Bitcoin network is entirely designed to keep the supply of Bitcoin at 21 million. A lot of people don't understand this. A lot of people don't know that Bitcoin is the discovery of digital scarcity. That's something that they don't see. This is the first time anything in the world can be sent and received digitally without having to worry about a third party in the middle, without having to worry about somebody facilitating the transaction for us. One of the reasons why diversification, the term, is thrown around so often is because money managers make more money if you diversify. For example, if you had a portfolio, a 60-40 portfolio or a target date portfolio, the money manager is going to make a lot more money than if you were to just buy Apple stock, or if you were to just buy, let's say, a bond in a self-directed account. So they want you to diversify. Their goal is to have you diversify because it's a financial benefit to them if you diversify. If you don't diversify, they're not going to make their management fees. They're not going to make their portfolio management fees, because all you're doing is you're holding one asset and you're just keeping it in your portfolio. Their management fees come from them giving you some kind of advantage over going through them. So for example, there are portfolios for the S&P 500 that get rid of any volatility. These portfolios are charging you 2%, but you don't need them, because just buying the actual S&P 500 and getting educated on what it is, you'd probably do a lot better, right? If you have the volatility, if the volatility is working on your behalf, then over time, your portfolio is going to grow a lot more than these portfolios that have muted volatility. Essentially, they've gotten rid of all the volatility. They try to give you a maximum return or a minimum return. And to do that, they charge you a fee. The reason why they do this is because a lot of people are scared of volatility. They're scared of seeing their portfolio go from, let's say, $100,000 to $70,000, or $500,000 to $150,000, $200,000, $300,000 during a downturn. So what they do is they give you this benefit of not letting you see that volatility, but then they charge you a massive fee. So they take a large chunk of your return. So your returns are going to be significantly lower. Diversification is just a way to smooth out your returns. It's more about feelings than it is about facts. It's more about not having to deal with the emotional issues of volatility. When you see your portfolio dropping significantly, a lot of people are going to get scared and they're going to sell their assets. But once you understand the asset you hold, then the volatility is fine. You're completely okay with the volatility. Once you study how Bitcoin works, you realize that this thing is going to keep moving up and down significantly. It's always going to rise 100, 200, 300%, and then it's going to drop 30, 40, 50%. And that's perfectly fine, because over time, this is how growth happens. You don't just grow with a flat price. If the price is just flat, it means that all of the excess returns are already taken out of this asset. For example, we have bonds. Bonds are generally not that volatile. More recently, they became volatile because people figured out that the investment that they have in bonds is not giving them the amount of returns that they need to match inflation. So a lot of people got rid of their bonds, and now bonds have dropped 50, 60% from the very top. Previously, bonds were seen as a flight to safety. It was seen as a way for people to get rid of risk from their portfolio, but it seems like bonds are actually more risky than pretty much anything else. If we look at how the long-term bonds for the US are performing, this is TLT. This is an iShares 20-year Treasury bond ETF. We can see here that at the peak in July 2020, bonds were at this TLT, this fund was at $171. It's lost 43% of its value. So what would have happened if you thought that I'm going to go with the safe investment? I'm going to diversify into the safe investment because I'm retiring in the next 2 years. Let's say you want to retire in 2022. So you just bought a bunch of bonds and you just thought, okay, the markets are going crazy. I'm just going to buy bonds. You bought them all here. And now your portfolio is worth 40% less, 30% less at this point when you retire. So safety, avoiding volatility, is actually not a good thing. Again, it depends on how old you are. When you're 60, 70 years old, maybe you want to avoid volatility because you want to be able to pay for your expenses. But I would personally say, instead of buying other assets, maybe it would be better to just buy the thing that they're supposed to represent, to buy whatever they're supposed to be a proxy for. So real estate is just a proxy for US dollars. Bonds are just a proxy for US dollars. The people who own these things, they don't care about the utility. Most people aren't buying real estate to live in. A lot of people are buying real estate. The people who are saving, the people who have excess money to spend on real estate, they're buying excess properties because they want to rent those properties out to someone else. So what I would say is, it may be a better choice to, instead of buying all these other things that are very likely going to underperform, but you have to have a very long time horizon to hold them. So for real estate, if you borrow money to buy a house, you have to have 30 years. You have to hold on to that property for 30 years in order to pay it off and really see the benefits of having a paid off property. But if your goal is to just get rid of the volatility in the short term, and you're okay with the volatility for the long term, maybe it would be better to have a emergency fund. With Bitcoin in general, if you hold on for 4 or more years, I think you're going to do pretty well. I always like going to this website, Priced in Bitcoin 21, to show you the difference between how Bitcoin is performing versus how gold is performing, or how stocks are performing, or how housing is performing. You can see here, 5 years, everything at the top, all of the primary things that people want to hold have all lost a significant amount of value against Bitcoin. We can see here, let's zoom in. United States dollar has lost 80% in the last 5 years. Crude oil has lost 91% in the last 5 years. Gold has lost 91% in the last 5 years. And this is after gold reached a new all-time high. S&P 500, again, another new all-time high, but it's lost 64% against Bitcoin in the last 5 years. United States median house down 85% in terms of Bitcoin over the last 5 years. So if you bought real estate, you would have lost a significant amount of your wealth over the last 5 years instead of owning Bitcoin. So let's go into one of these charts here. We can go all, just so we can see what the trend is like. If we look at the dollar value, it's always going up. The price of a house is always going up because the amount of dollars in the economy is just going to keep increasing. It's just going to keep going up because more and more dollars are being printed. The US government is spending $1 trillion a year in interest alone. So it's going to keep adding more and more dollars to the economy. It's going to keep borrowing. And what these dollars are doing is they're not being used for consumption because there's a maximum amount of things that we can consume. You can't consume more food than your body can handle, right? You can't keep eating and eating and eating. So what you need to do is you need to buy other things. You need to either consume with maybe entertainment, or maybe you need to buy rental properties to save your value instead of holding dollars. That's what the financially literate do. So what's happening is, as the amount of dollars in the economy is increasing, price of housing is increasing in dollars. But again, it's all relative. This is all, the most important thing here is just looking at it relative to Bitcoin. So we can see here, in 2011, September 1st, 2011, a house cost $217,000. The same house cost, I'll switch from Satoshis over to Bitcoin here. You can see if the same house at the same time cost 26,399 Bitcoin. Today, we can see here the US dollar price of a house has literally doubled, $434,700, but the price of a house in Bitcoin has dropped by 99% to 7.19 Bitcoin. And over time, we're going to see lower and lower prices for this. So if let's say you have a 50 home portfolio and your portfolio is worth 100 Bitcoin today, eventually it'll be worth 10 Bitcoin. Then it'll be worth 1 Bitcoin. Then it'll be worth 0.1 Bitcoin. I think that prices of homes will continue to decrease just based on the technology that's coming up. We have 3D printed homes. We have stackable homes. More and more houses are being built, and it's going to be easier and easier to build them going forward. On the other hand, with Bitcoin, it's going to be more and more difficult to create more over time. So what's going to happen is we're going to see this price decrease significantly. We're going to see it drop 99%, 99.9%, 99.99%. So why would you intentionally choose to diversify into something like real estate when you know that the value is going to decrease? Let's look at stocks. Same thing. We go all. The S&P 500 is a list of the 500 top companies in the US. So 500 companies, you buy all these companies, you buy one share, and you have exposure to everything. Let's look at the fiat price. So in terms of fiat currencies, the S&P 500 has gone from 1,132 per unit per unit, I guess, and it's gone up to $5,295. It's hit new all-time highs. But in terms of Bitcoin, it hasn't. In terms of Bitcoin, it's just going down. We can see here in 2011, August 15, 2011, when the S&P 500 was $1,132 US dollars. In Bitcoin, it was, I'm going to switch over from Sats here, just so we're not cherry picking. I'm just going to go all the way to the end. It was at 100 Bitcoin at one point. But at one point, it was also up to 496 Bitcoin. It was up to 496 Bitcoin at one point. But today, one share, again, in dollars, it's increased by 5 times. But in terms of Bitcoin, it's dropped 99.9%. And it'll keep dropping. So we can see here, one share now is 0.088309 Bitcoin. Eventually, it'll be 0.00888309 Bitcoin. Then it'll be 0.00, whatever. We'll add more zeros. It'll just keep adding more and more zeros. That's the point. But it'll get worse and worse and worse. All of these assets will drop in value because we don't need them anymore the way that we did with a US dollar standard. That's what Bitcoin changes. So again, we can look at gold, go all. We can see here that in 1 ounce of gold, I'm going to switch over from Sats to Bitcoin and add fiat. You can see here that 1 ounce of gold was at one point 668 Bitcoin for 1 ounce of gold. 1 ounce of gold, 668 Bitcoin. In the beginning of this chart, it was $162 Bitcoin per ounce. And at that point, it was $1,837.90 per ounce of gold in US dollars. Now, the price for an ounce of gold in US dollars, I'm not sure why this is not updated. I think it's around 2,400 in terms of US dollars. But in terms of Bitcoin, it's just dropped. It went from 600 Bitcoin all the way down to 0.03 Bitcoin per ounce of gold. And this number will keep decreasing. It'll go to 0.003, 0.0003, and it'll keep dropping more and more and more until the world realizes, until the world gets rid of gold as a monetary good. And we start just using gold as a industrial good, something that can be used in industrial processes. So in the current economy, even if you think you're diversifying, you're really not, because everything is impacted directly by interest rates. When interest rates go up, every asset's price comes down. When interest rates go down, every asset's price goes up. The difference between all of these other assets, like let's say, you can probably see that when interest rates go down, Bitcoin's price also goes up. But the thing is that with Bitcoin, it's a little bit different. Bitcoin's price is also going up because of adoption. Most people have zero allocation. So over time, even if interest rates keep going higher and higher and higher, Bitcoin's price will go higher and higher because more and more people will want it, and there's a finite supply. Bitcoin can, at some point, I don't know when this will happen, could take decades, could take years, could take months for all we know if some kind of credit event happens. We could see Bitcoin replacing the US dollar as money for the entire world. I think that's something that can happen pretty quickly if the entire world figures out what Bitcoin is. All this is going to do is it's going to make it so that more and more people are putting their resources into developing Bitcoin, making it better, scaling it, making it grow. Okay, so if we go back to the same email here, we can see, as opposed to putting everything into Bitcoin and finding out it doesn't catch on or has other problems, this is something that I want to go a little bit into as well. Regulatory problems only affect you if you're in certain countries. Keep in mind that governments are not able to regulate you in the entire world. The US government may be able to ban Bitcoin, but it can't stop you from using it in other parts of the world. They can't stop you from using it in China. They can't stop you from using it in Canada. They can't stop you from using it in India. So as long as Bitcoin remains decentralized, and I think it will, I don't see any reason for it not to. As long as Bitcoin remains decentralized, regulatory problems don't make a difference, because when you assume that regulatory problems will make a difference, you're assuming that only one country's market, one country's economy is what matters. There are already countries that really want to get away from the US dollar, and they're actively looking into Bitcoin. They're accumulating Bitcoin for themselves. The US government has 213,000 Bitcoin of its own. So I don't really see a reason for the US government to ban Bitcoin, to regulate it, to stop it from being used the way it is. If anything, I see the US government promoting it even more because it's a way for them to get out of their debt, the debt that they owe. As they hold Bitcoin, as they own Bitcoin, maybe they'll accumulate more. I think they should. I think that's just the way it goes. As they accumulate more and more Bitcoin, the value of the dollar continues to decrease, and the debt that they owe, the $35 trillion debt, can be paid off with this Bitcoin. And they can pay their Medicare, they can pay their all of the things that they have to pay for. They can pay for Social Security with this Bitcoin holding. Over time, if they get to a certain level and Bitcoin's appreciation keeps increasing, they'll be able to pay for their bills while keeping the vast majority of the Bitcoin that they have accumulated over time. Taxes. Again, this is something that I don't see being an impact on Bitcoin, because with taxes, the only reason why governments are able to force us to pay taxes on property taxes, or on properties, on real estate, on stocks, is that they are held with centralized authorities. And these centralized authorities are controlled by the government, by the US government, Canadian government, wherever you are, they're controlled by these authorities. And if you try to take your money out of your, let's say, stock portfolio without paying taxes, your government's going to figure it out. And the next time you try to take it out, they're going to lock your account. If you don't pay your taxes, they're going to lock your accounts. They're going to lock all of your assets. So again, this is something that I don't think will impact Bitcoin, because if you have to, you can you can just go to another country and sell your Bitcoin there. You can use their exchanges. There are countries around the world that are actually giving you 0% capital gains taxes on Bitcoin. And Bitcoin is the same asset around the world. So if you were to go to these countries, you sell your Bitcoin, you don't have to pay taxes, you're better off. I think what's going to happen is, instead of charging taxes on the actual Bitcoin holdings, on capital gains taxes, because it'll be so difficult to track, I think what governments are going to do, not companies, governments, what governments are going to do is they're going to tax the merchants directly. They're going to charge a consumption tax. And whoever is buying goods and services, they'll just pay that consumption tax while they're buying those goods and services. What this will do is it'll disincentivize consumption. It'll incentivize saving. It'll give more people a reason to hold on to Bitcoin, and it'll make Bitcoin's adoption get even faster. So taxes I don't see as a negative. I think taxes are going to be a positive once governments realize what exactly Bitcoin is. So the third issue here, competing coins, I don't see this as an issue either. Bitcoin is the discovery of digital scarcity. What this means is that it's the first time we've ever had something that you can transfer of value across the internet without relying on centralized parties. Today, we can send dollars, we can send euros, we can send yen, whatever the currency is, over the internet. But the issue is we need centralized parties. We need banks, we need financial institutions, and all of these financial institutions are taking a small chunk of that value from us. So let's say if you were to send a wire transfer for $1,000 to somebody in another country, your bank is going to take $50, $60, $75 from you for sending that wire transfer. Maybe it's lower now, maybe it's at $15, $30, whatever it is, but they're going to take a large chunk of that value from you. On the other hand, with Bitcoin, you can send that value for a very small amount. Right now, the fees are under $1. So all these competing coins, what they're trying to do is they're trying to improve on Bitcoin. They're trying to solve, there's something called the blockchain trilemma. They're trying to solve it. This is a great graphic that shows you the components of the blockchain dilemma. So there's decentralization, there's scalability, and there's security. What you have to do with any network is you can pick 2 out of 3. If you pick scalability, you're very likely not going to be decentralized or secure. If you pick decentralization, you have to give up on one of these 2. If you pick security, you have to give up on one of these 2. So with Bitcoin, Bitcoin has chosen decentralization and security. Nobody's ever been able to hack Bitcoin. Bitcoin is the most powerful network in the world. It's also decentralized, meaning that there are tens of thousands of computers around the world that are running this software rather than the current financial system where only one computer runs the entire financial system. So this one computer is the only node, it has the only record of transactions, and nobody else has a record of those transactions. What a lot of altcoins, a lot of competing coins are trying to do is they're trying to scale on the base layer. The reason why this doesn't work is because when you scale on the base layer, you're going to have all these transactions being done on the base layer, and the computers running that base layer, that competing currency, they're going to have to increase their capacity for storage. So they're going to have terabytes on terabytes on terabytes of data that they're going to have to store. On the other hand, with Bitcoin, the minimum size of a block right now is 1 megabyte. The total block, the total size of the entire Bitcoin blockchain is under 1 terabyte. What this means is that anyone in the world can run a Bitcoin node. They can run Bitcoin Core, they can run a full node, and they can confirm every single transaction that happens. What this does is it makes it so that it's harder and harder to manipulate the network. If everybody in the world has a copy of the ledger, they can all confirm and make sure that the transactions on that ledger are accurate. So let's say some random party comes in and let's say the US government comes in and they think that they don't have enough Bitcoin, and instead of buying it because they don't want to inflate the currency, they just try to create a block where they add 3,000 Bitcoin to their own wallet or 3 million Bitcoin to their own wallet. What's going to happen is this block is immediately going to be rejected because of the decentralization. The decentralization, what it does is it gives multiple people the authority to confirm whether transactions are accurate. If the transactions are not accurate, they're going to be rejected. So what these other cryptocurrencies are trying to do is they're trying to make the base layer of the blockchain as big as possible so you can get final confirmation, final settlement on every single transaction. What settlement means is if I were to give you cash and you were to give me whatever you gave me, whatever product it was, let's say I wanted to buy this water bottle from you and I wanted to give you cash. Once I give you that cash and you give me the water bottle, the transaction is settled. It's final. With Bitcoin, when you have a transaction that goes on the base blockchain, the base layer, it's settled, it's confirmed, it's not going to be reversed. A lot of people try to compare Bitcoin to Visa or MasterCard, whatever it is, whatever the current technologies are. But what they're doing is they're comparing something that gives you final settlement to something that doesn't give you final settlement. This part here, the scalability, is not something that we're going to solve on that base layer. All these other competing currencies are trying to do that. They're trying to make it so that all of these are solved, but that's not possible. It's impossible because the reality is there are always going to be trade-offs. There's going to be opportunity costs. Your opportunity cost for wanting decentralization is the lack of scalability. If you want decentralization and security, you're not going to be scaling on that base layer. What we're going to do over time is we're going to improve the technology that's built on top of Bitcoin. Just like Visa and MasterCard are built on top of the financial system, Visa and MasterCard are the way for the legacy financial system to scale, but they don't give you final settlement. What Visa and MasterCard are doing is they're just authorizing a transaction, and then in the future, it's being settled. So let's say if you wanted to tap your card to buy something, you can go back to Visa and you can say, this is a fraudulent transaction. Visa is going to, they're going to investigate the transaction and they're going to reverse it. The merchant is the one who takes the hit because you have whatever you bought, but the merchant got their money taken away from them. So when you compare all of these other cryptocurrencies, these competing currencies that are trying to solve this Bitcoin trilemma, there's always going to be a trade-off. When they tell you that they've solved the trilemma, they're lying. They haven't solved anything. There's always going to be trade-offs. This is how the real world works. With Bitcoin, it is decentralized, it is secure, it's not scalable, but there are ways to scale it. So we can have the Lightning Network, we can have Liquid, we can have other technologies that are built on top of the Bitcoin base layer that'll help it to scale. You won't be able to scale on the base layer. We're always going to rely on trusted third parties when we want to send and receive money. It's just that in the current system, all of those trusted third parties are intertwined. All of them work together. They're all insolvent. Every single one is in debt. They all owe money to their depositors and they don't have enough money to pay back their depositors. On the other hand, with the Bitcoin network, if things work out the way that they should, there's going to be multiple ways to have trusted third parties, multiple trusted third parties. All of these trusted third parties won't be reliant on one another. Each one will be individual. So let's say there is a collapse or something happens where interest rates have to go up. Let's say one of these trusted third parties goes down. Not every single one will. On the other hand, with the current financial system, if one trusted third party goes down, it means that pretty much the entire financial system is gone. It's done because it's all centralized. So if the Federal Reserve were to have something happen to them, if they got hacked and somebody erased all of their records, I don't know how far that'll go. I don't even think the financial system will be able to recover from that. So that's a problem. When you see somebody who's offering you a alternative cryptocurrency that's supposed to solve all of these problems, a competing coin that's supposed to improve on Bitcoin in general, it's just somebody who's trying to take your money from you. They're not actually creating value. They're trying to take your money from you. They're trying to get you to not buy Bitcoin, and they're trying to get you to add liquidity to their random altcoin. They're getting you to buy their useless coin that really has no value. So this explanation has gone on long enough. Of course, I'm going to cut it off here. The person is a maxi. They're 60 years old, like I said before. Michael Saylor says diversification is taking good investments and putting them into bad investments. I completely agree. Again, I mean, what JR is seeing here is obviously correct. It depends on where you are in life. Like I showed you, if you're 60, you may want to allocate less to Bitcoin. If you don't want to deal with the volatility, maybe you want to buy bonds. But if you're in your 20s or your 30s, maybe it wouldn't make any sense to buy any of these assets. Maybe it would be much more sensible for you to go all in into Bitcoin, but only once you understand what it is. If you don't understand what it is, of course, you're going to sell early. You're going to get scared of the volatility. You're going to get rid of it. You're going to miss out. You're going to lose more than you actually make. Just to piggyback off this question, I also created another video that explains to you why $1 million in stocks, real estate won't be enough to retire, and how you can use Bitcoin as your retirement plan. If you want to watch that video, it's on your screen right now. If you found value in this content, please leave a thumbs up or a comment down below.